You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the Investing Matters podcast. Today, I have the privilege of speaking with Nick Britton, Head of Intermediary Communications at the Association of Investment Companies. And Nick is a former financial and business journalist, and Nick joined AIC in 2015. How are you, Nick?
I'm very well. Thanks very much for having me on the podcast.
Thank you very much for joining us. I'm thrilled to have you on, Nick, because I know that the huge amount of work that you and your colleagues do at the AIC and the importance of it. So I want to start our conversation really with the educational aspects for you, and then going from uni to Shanghai. Why Shanghai? Let's start there, please.
Sure. So I grew up in Bolton, near Manchester. My parents weren't from there. They both moved there. So I'm sort of a semi kind of northerner, because born and bred in Bolton, but my parents are not from there. So I grew up speaking a little bit different to everyone else in Bolton, which occasionally was cause for a little bit of ribbing at school, but I managed to survive that. I then went to university at Cambridge. I studied English. And after that, really, I felt I wanted to do something completely different, because I felt like I'd lived my whole life, I'd been in education, I'd been mixing with a certain kind of people. And I felt like I want to go somewhere totally different. And I was quite open-minded about where it would be. So fortunately, I'm very lucky to be a native speaker of English, and at the time anyway, that was like a free passport to go to lots of different countries and teach English. So I applied for about half a dozen different jobs teaching English in, I think, Greece, Turkey, Sri Lanka, Japan, China. And it just so happened that the people in China, in Shanghai, got back to me first. They were the most desperate, and after a fairly quick well, I think it's true, after a quick sort of half an hour interview, they said, yes, we'd like you to buy your ticket and come to Shanghai and teach English. So I thought that my parents were a bit worried at that point, as you could imagine. But I thought it was great. So I went over there. I'd have a fantastic time. That I didn't intend to stay for 3 years, but I did. I met the woman there who's now my wife, and lived in other countries as well before sort of coming back to London. So yeah, it was a major decision that was almost entirely the result of chance rather than any serious thought. But yeah, that's kind of defined the direction of my life, really.
Brilliant. Now, what was your main learning and life experiences from that 3 years of being in a completely different environment? Obviously, you met your wife, and that changed everything for you as well.
Sure. I was fascinated by Shanghai, right from day one, because it was so different. I mean, if you think, Bolton, yeah, I'd seen.
I know Bolton, yeah.
I'd lived in Cambridge, and of course, I'd been to London, a few times, but I'd never been to the US, for example. So I'd never seen, really big, high-rise cities before, for a start. Now, maybe if I'd seen New York or something, I would have a bit less impact, but I'd never seen that for a start. I'd certainly never seen anything like Shanghai, which was growing so fast at the time. You could go away from Shanghai for a week and come back, and there'd be new buildings in your street. That's how fast it was growing. The pace of life, the attitude of people was so different. There was excitement about the future, and a sense the future is going to be better than the past. People are very entrepreneurial, business-minded. You only have to talk to somebody for 5 minutes, and they're thinking, okay, what's the angle here? Maybe you could come into a business with me. That's completely different from what I've been used to. So it was really sort of fascinating. You saw how different culture could be, how different people could be, but at the same time, the similarities. And it's hard to, it is a bit of a cliche about travel broadening the mind, but I think I'd recommend it to anybody who's lucky enough to have the opportunity to go and live in a completely different country, because I think it does give you a different perspective on things, and it makes you sort of appreciate and understand your own country a lot better as well. And I certainly would feel like I do that because I've sort of lived somewhere else. So it gives you a different perspective on things, which I think is very useful.
Brilliant. Now that perspective, obviously, you utilised. You came back into the country, and then you got various different jobs as a journalist,
Yes,
editor of What Magazine, head of research at Vitesse Media, which is now part of Bonhill Group, and you
yes.
produced reports for directors' pay on AIM, Cash Sales Directory, and lots of other bits and pieces and VCT reports. Now, what was it about that work and a certain boss that triggered your interest back in investing all over again?
Sure. Well, I suppose I'd always been interested in money and in saving, but I hadn't any sort of family background in investing at all, really. And I became interested in it in my mid-20s when I started to work, as you said, at what was Vitesse Media, talking to entrepreneurs, people who set up companies, really, really fascinating people, doing research into the AIM market, starting to research into VCTs, and then going through the global financial crisis, which, for somebody just starting out in financial business journalism was, obviously devastating for a lot of people, but really kind of fascinating from a journalist point of view to understand, what was going on there and how had, these strange machinations with some obscure financial instruments managed to cause, almost a collapse of the whole financial system that I think we're still dealing with the fallout from in lots and lots of different ways. So I was hooked really then on sort of finance and business. And then when I started to get into investments, I became really interested because I was already investing myself by that time. And I started to see the connection between what I was writing and the way that the value of my portfolio was going up and down. And I suppose the other thing that really fascinated me about investing, and still does, is the fact that performance is so transparent compared with an awful lot of other industries or walks of life, where it is genuinely very hard to assess somebody's performance. In investing, really, it's very easy to see how a certain strategy or manager has performed, and there's nowhere to hide. And I love the way that sort of numbers and personalities come together with economics and also people's personal finances, which is hugely important to all of us. So from then I didn't sort of look back. The boss you're referring to is of course Annabelle Brodie-Smith at the AIC.
Oh, I didn't know that. Okay.
I think you set that one up nicely, Peter. I noticed what you did there. And I know Annabelle's been on the podcast before, so perhaps people heard that interview. But I'd worked with Annabelle when I was a journalist, so I was on the other sort of side of the fence, and she was trying to persuade me to write about investment companies, which wasn't hard because they're really fascinating.
Brilliant.
And when I sort of come a bit to the end of the road with being a journalist, I sort of had enough of it. This opportunity came up to work at the Association of Investment Companies, the AIC, where I am now, with Annabelle, and I thought, well. It's always, moving from journalism to PR, you worry a little bit about, am I selling out? Am I going to have to push clients and products that I really don't believe in? But I thought, well, if I'm going to do it, and this is a great opportunity because I'm going to be working with Annabelle, who I know very well, and the team at the AIC, Gemma Jackson as well, of course, moved on to Interactive Investor, was there at the time as well. And so it's a great team, and it's a product that I really believe in, actually, and invest in myself. So I'm not going to feel awkward or embarrassed about doing this job at all, because we're helping to promote what is a great and also very underrated fund structure here. So that was the somewhat kind of roundabout route by which I ended up at the AIC in the communications team, working with journalists, but also financial advisors and wealth managers to help them hopefully understand investment companies a bit better.
Absolutely. And so we're talking now around 2015 you joined, was it?
2015, that's right. Yeah.
2015. So you've been educating everybody since then, but you work mainly with financial advisors, wealth managers, supporting them with the use of investment companies and VCs. Now, I've already spoken, obviously, as you said, with Annabelle, but I just want you to just cover a little bit the differences between investment funds and investment trusts, just for our listeners, to just clarify again and reiterate again the nuances and differences between the two, if you would, please, Nick.
Absolutely. So I think the first thing I'd say is that investment companies, or more commonly known as investment trusts, are actually funds. They are funds. They're just a kind of fund. but they are different from what's normally referred to as funds, which are open-ended funds. So investment, if I start off with investment companies, they are companies that are listed on the stock exchange, just like any other company, just like Unilever or HSBC. Every investment company is listed on the stock exchange. But unlike HSBC, it doesn't do any trading business. It doesn't sell products or services. An investment company exists just to invest. And by buying shares in that investment company, you get access to that investment portfolio that it invests in. Now, obviously, most funds are not like that. Open-ended funds are sort of pools of money that are run by an asset manager to give you exposure to underlying investments, but they're not companies quoted on the stock market. So that's a very key difference. Now, because investment companies are quoted on the stock market, it has a number of important ramifications for investors. They have boards of directors, independent boards of directors, who are put in place solely to look after the interests of shareholders. And that's very important. They trade, they trade as a share price, which might be higher or lower than the value of the assets in the fund. And that's why we talk a lot in the investment trust world, and you hear people banging on about discounts and premiums. That's why they're talking about the difference between the underlying assets value and the share price at which the investment company shares trade. And it does, those things are different, and that's why you get the discount or premium. And also investment companies are able to gear. They're able to borrow money to invest. Most of them don't. Just over half investment companies don't have any gearing, but some of them do. And that's something that can help enhance their returns over time, although it also adds some risk. So those, I think, are the main differences between investment companies and other funds.
Excellent. Love that full reply. Thank you very much. Now, as I said earlier, you work mainly with financial advisors and wealth managers and so on and so forth, Nick, and the use of VCTs. I want to talk about that a bit later on, but please, can you expand really on the sheer scale of the work, the importance, and why the benefits and the positives for investors and the Investing Matters listeners? Because obviously you're working with, well, I've got it here, the Chartered Institute of Securities and Investment, the Chartered Institute of Securities of Investors per se, global, nationally. So it's a massive scale of work that you're actually doing to try and get these intermediaries aware to impart the knowledge to everybody.
Yeah, well, it's very kind of you to say that. I mean, I'm just one person at the end of the day, but with a team. But in terms of the advisor work we do, that's mainly on me, the sort of advisor training and education work. And the reason for that is that traditionally financial advisors didn't really use investment companies at all, apart with a few very notable exceptions, because investment companies didn't pay commission to financial advisors. So financial advisors obviously avoided them and used open-ended funds. Now that the commission situation changed 10 years ago, it was banned, which means that more advisors have started to look at investment companies, but still, old habits die hard. And most of the advisor industry doesn't use investment companies. And we obviously think that's a shame, because we think there are great advantages to investment companies that could be suitable for a lot of advisors' clients. Obviously, they're not going to be right for everybody, but most advisors would have clients who, we think probably would benefit from using investment companies. So the purpose of the AICs, sort of training and education of financial advisors, is to make sure that at least one of the barriers, which is sort of lack of awareness and understanding, it is actually addressed and hopefully broken down. And that's why we've trained over 10,000 advisors since RDR. Not all of that was me. I joined in 2015, but some of it is me. We work with the, as you said, the CII, the CISI, who are the sort of professional bodies that advisors use to sort of be members of, take their exams, maintain their professional standards. We work with them as much as we can. We work with individual advice firms when they want trading on investment companies. We do our own events and webinars and e-learning available on our website. So any avenue we can really to spread the message about investment companies, but it's very important that we do that in a responsible way. And I think one of the good things about working for a trade association is you're sort of isolated from that sort of pressure to sort of to sell, basically. So we're not doing a sales pitch when we're doing our training. We are, presenting a sort of responsible and balanced view of investment companies, but we are talking about occasions when they might be suitable to use with clients. So that's the sort of ethos of our trading and what we do. And obviously, we try to reach as many people as possible. And we might talk later about the work we do with private investors, which I'm also involved in.
Brilliant. Yeah, thank you for that. Now, what I've noted as well, Nick, is that we've had a significant increase in the awareness and the growth of VCTs. Yeah. Please will you share with our listeners the often overlooked specialist and efficient benefits, and also the risks of venture capital trusts, please?
Of course, yeah. So venture capital trusts are a very particular kind of investment company because they invest solely in small, usually unquoted UK businesses. And when I say small, I'm not talking about the kind of small we're talking about when we say small caps. I'm talking about really small, so assets of less than 15 million, the kind of companies that wouldn't be quoted on the stock market unless we're talking about AIM, the kind of companies that might struggle normally to get funding. And the VCT scheme is set up to help those companies get funding so they could grow, hopefully hire more staff and create more wealth for the economy and ultimately tax revenues for HMRC. Now, to encourage people to invest in VCTs, they attract considerable tax reliefs. So we're talking about 30% upfront income tax relief, which is like if you say invest £10,000 in VCTs, you knock £3,000 off your tax bill for that year, income tax. Tax-free dividends, and also tax-exempt capital gains. So it's a set of tax reliefs that's quite attractive. And one reason that, as you said, VCTs have become more popular is because of the way people have become more restricted in what they could put into their pensions. And that sort of tapering of the annual allowance has led to more demand and more interest among advisors for VCTs for their clients. But as you also rightly pointed out, they are a high-risk investment. Investing in these smaller companies carries obvious risks. They don't always succeed. The good thing about VCTs, though, is that they put together diversified portfolios of these companies run by professional managers. So if you're going to invest in this part of the market, and it is quite exciting, then VCTs are actually, if I could put it like this, quite a conservative way to do it, quite a mainstream way to do it. They've been around for 26 years. The managers who have been running these things have a lot of experience in doing it. And of course, you get the tax reliefs, which gives you a kind of cushion for any loss that you might experience. And tax-free dividends as well in the past have been we're talking mid to high single-digit yields, but typically now it's to target dividends of around 5%. So yeah, a number of reasons to sort of look at VCTs, but yes, have to stress they are sort of high risk and are often used by people who have sort of maxed out ISA and pension allowances.
Brilliant. Love that response. Thank you very much, Nick. I've got some stats here, which I thought was absolutely mind-blowing. So venture capital trust fundraising was up 11% in the year 2020 to 21 tax year, having raised 685 million for investment in small and innovative UK businesses. And then year 2021 to 2022, record levels of fundraising, 1.13 billion tax year. So clearly the work that you're doing and the team in raising awareness and helping these companies to showcase what they're doing regarding VCTs is working.
Yes, well, I certainly hope so. I think also some of the reason for that big growth is that clearly the year before, the tax year ending 2020, we had the COVID pandemic, and that did hit fundraising quite a bit. And since then, it's bounced back very strongly, as you said, which is nice to see. But there'll always be opportunities, and even though it probably sort of doesn't feel necessarily comfortable to be putting money into small UK businesses at the moment, great businesses are created in tougher economic times. And I believe Microsoft was created in the sort of mid-70s US recession. The global financial crisis saw the creation of businesses like Zoopla and Airbnb, for example. So it can be actually quite a good time to invest, but these are long-term investments. I should have pointed out earlier, there's a minimum 5-year holding period to actually get all of the tax reliefs I talked about. And you should probably be thinking about that as a minimum, rather than necessarily you're going to be in for 5 years and then immediately sell out.
Indeed, indeed. Now, looking at the investment trusts and investment companies, Nick, one of the stats I've got here is that private equity and smaller companies feature prominently in the top performing investment trusts of the past 30 years. Why do you think that these class of investment trusts have outperformed, and do you think this could continue, this outperformance, over the next decade or so?
Yeah, great question. I love private equity in smaller companies. I've got both of them in my own personal portfolio, as we might come on to talk about later. Good. I mean, the great thing about the investment trust structure or investment company structure is the fact that it's closed-ended. What that means is investment companies don't have to sell their investments when people sell their shares. And so it's very suitable for investing in things like private equity. Because if you're investing in private businesses that aren't on the stock market, there is no way to sell them quickly, and you shouldn't be trying to do it. So an investment company is a great structure for that. Equally for small companies, as you know very well yourself, they might be quoted on markets, but they'd be quite illiquid, quite big spreads. Again, you don't really want to be selling those in a hurry either. So again, investment company structure is great for investing in those things. And both of those asset classes, private equity and smaller companies, obviously there's quite a lot of academic research that suggests they do outperform over the long term. Perhaps a bit more contested with private equity than with smaller companies, but a decent body of research that shows there are good reasons to think that they can deliver very good long-term performance. And again, looking at the situation we're in at the moment, there's some very big discounts on private equity investment trusts. That doesn't necessarily mean go and fill your boots, of course. There may be more of this downturn to come, and discounts might always widen even more than they are at the moment. But historically, if you buy decent investment trusts at a big discount, then over a longer period you can do very well indeed. So I think those are interesting asset classes to look at, although they can be volatile, and they may well be very volatile over the next 6 to 12 months.
Thank you very much for that full reply. Now, I want to ask a little bit about your work with private investors, because I know and I've seen you at various different shows where you go and you discuss and embrace, us little minions as private investors, and you share the information. You and Annabelle have done that so well over the years. So tell us a little bit about that work and the nuances of that.
Okay, I'm not sure about minions. I was quite starstruck actually when I saw you at one of these private investor events. So I think that's the wrong way around. But yeah, no, I really enjoy talking at private investor events. Even though, as I've said, most of the work I've done at the AICs with advisors and private investors. I used to edit a magazine called What Investment, which is was for private investors, and more kind of keen, sophisticated private investors. And so it's nice to kind of go back to my roots in a way and talk to them. And often you learn quite a lot from them, because they're bound to know more about the companies they invest in probably than you do. But it's interesting to talk to them more about investment companies and the sort of trends in our industry, maybe areas they haven't looked at. And yeah, so we do quite a lot of work talking at private investor events, but we also probably do a lot more work through PR, through the media, through getting our message out there, through personal finance magazines, newspapers, websites, podcasts like this one. And it's something that we're very keen to do. Our website also is has lots of material for private investors at all different levels of knowledge and sophistication. We've got a guide to investment companies. I worked on that, a lot of work on that to try and make it as sort of accessible as possible. Not always easy when you're explaining things like discount control mechanisms and things like that, but we've done our best to make that as open as we can, so people can go in there with various different levels of knowledge and learn something and understand a bit more about whether investment companies might be right for them.
Yeah, I must say the AIC website is an absolute treasure trove of information. So please, can you share with us, where will they find this treasure trove of information? The website address, please, Nick.
Fantastic. Thanks for the question. It's www.theaic.co.uk.
Brilliant. Now, I want to talk a little bit. Obviously, you're a private investor yourself, ISA, SIP, etc. And in this segment, I want to ask you really about your own personal style of investing, Nick. Your own different sort of filters that you've used and why you've ended up with the portfolio that you have. And then I'm going to ask you a little bit about, what you've done regarding the youngest part of your family as well. So
Yeah,
start with
sure.
yours, please.
Great. So yeah, when I went into investing in my mid-20s, I think I made quite a lot of mistakes. One mistake that I have never made is, and I don't say this I don't mean this is always a mistake, but it would have been for me, is investing in individual stocks. Because I don't feel I have and I know this is controversial, very controversial to say on this podcast, but I feel personally, I don't have the skills, knowledge, time, or inclination to do my research into individual companies. And lots of people do, and good luck to them. And in fact, we need people to do that to maintain an efficient market, but that is not for me. So I've always preferred to invest in funds. I started off investing in open-ended funds and in investment trusts. I've moved more to investment trusts, investment companies, because of clearly my work. I feel like, I perhaps have some kind of advantage here in dealing with investment companies in my work. So I only invest in investment companies now. My investment style or strategy, such that it is really determined by what I'm doing it for, and it's largely for my retirement. And despite appearances, that's still quite some time away, unfortunately. So I am, a long-term investor, really. And when I say long-term, probably got 20 years left, and that's why, a market downturn like this one, whereas it's still nobody really enjoys it, do they? It's not very nice to go and log into your account and see the value of your investments falling that much. But this, on a longer term view, you have to be sanguine about that, and you have to be calm about that. And so I'm very long term. I'm 100% equities, because when I say equities, it's a very broad sense. It includes a bit of private equity. It's very globally diversified. But I haven't really seen the point in investing in bonds, I'm afraid, at my time of life. It may be something for me later. So I've gone all in on stock markets, just because, the ample evidence that over time they do produce better returns than any other asset class. And investment companies, because again, they long term, they do tend to produce better returns investing in assets like equities, small caps, private equity, than other types of fund. So that's what determines my sort of broad approach. And as I say, I've got a number of investment companies giving exposure to, across the world, small, large, value and growth as well. Not all in growth, which I'm pleased about, because it would have been quite painful if I had been this first half of the year. And in fact, a lot of the investments that haven't been doing very well over the recent years, and it's been quite painful to keep putting money into them, have really paid off in this first half of the year, it's a great lesson about diversification, isn't it? That sometimes investments that you really sort of have got tired of, actually they really come up trumps in a period like this. So that's it, really. It's keeping it diversified. I rebalance. I tend to rebalance not by selling chunks because I want to keep my transaction costs low, but because I'm still in my accumulation phase. I'm still putting money in every month. I rebalance by putting it into the things that have fallen most. And again, that's kind of an automatic. It's not an active decision every month. I just look at what's most below my sort of target sort of percentage of my portfolio, and put the money into that. And that means, of course, that you end up buying things when they're beaten up. So at the moment, all the things I'm buying are the kind of growthy names that have sort of fallen a lot, whereas in more recent years, the things I was buying were the more sort of value names, which were performing very dully. But that's another thing. I find the more you can kind of automate your investment process, and the fewer active, well, I say you, and again, I should stress this is all for me. It's not necessarily, it's definitely not for you. I'm sure it's not right for a lot of your listeners, but it's just what works for me. And I find the fewer active decisions that I have to make, the more calm I am, and probably the better I do. Because whenever I've tried to be sort of clever in my investing, in inverted commas, I've pretty much always made less money than if I hadn't tried to be clever and just stuck with my original plan.
Brilliant. I love that reply. I want to go back in a couple of the things that you've said there, Nick. And the first thing you almost said was the mistake, and I don't do, regarding investing in individual stocks. Now, we've had several fund managers and other people in the investment industry on this podcast, and they're very much in the same sort of boat, in the sense of they don't want to make the decision. They haven't got the time. They don't want to spend all that time researching individual stocks. So it's not a mistake. It's the right thing, and it's what works for you. So that's what you should do. I wanted to ask about the other aspect of, you mentioned about the rebalancing. For our listeners, can you explain what rebalancing means for you and what that should mean for them if they're considering it?
Yeah, of course. So for me, what I have is, well, I guess you would call it, if you were using some jargon, strategic asset allocation. But to use plainer English, what it is, it's just the percentage of my portfolio that I want to have in each investment company, in my case. And I've worked out already what the kind of underlying exposure that's going to give me. So, for example, per country, or growth versus value, whatever. But it boils down to, I want to have X% in this investment company, Y% in that investment company. And then what rebalancing is normally, if you're a financial advisor, for example, looking after a client's portfolio, is that every month or every quarter, you would sell some of the investments that had done well and buy some of the investments that had done badly. So you brought your portfolio back in line with that target asset allocation. Now, in my case, because I have a bit of tolerance to kind of drift away from the asset allocation, also because I don't want to be spending too much money in trading, buying and selling all the time, I rebalance just by buying the things that have fallen most, rather than sort of selling anything. But if things got too out of line, if one investment shot up by 300% or something, which would be a nice problem to have, it's not going to happen this year, yes. I don't think. But if it did, I'd have to seriously consider selling some of that to bring it back in line. So that's what I mean by rebalancing. And I think everyone goes on about diversification, which is brilliant. I think it's rule number one in investing. Don't put all your eggs in one basket. But coming a very close number two is rebalancing. Selling things that have done well, buying things that have done badly. If you do that sort of consistently in your portfolio, then you're really going to add lots of value, almost just kind of mechanically, over the long term, without having to do too much active decision making.
Brilliant response. I love that. Now, you talked also about automating your investing, and I'm assuming that means a little bit of drip feeding, but could you expand on what that means for you, please?
Yes, I meant, I was referring to really having that sort of target asset allocation, buying things to bring it back. But also, I should probably say that, every few years, every 5 years or so, I allow myself to look at that target asset allocation and to look at the different funds in my portfolio and to think, well, are they still right? Is the target asset allocation still right? So, for example, in 2020, I had a big overweight to emerging markets. I still got quite an overweight to emerging markets, but I took it down in 2020. Not sort of a huge amount, but I just took it down a bit. I felt like I don't have enough in the US. I've got, too much in EMs. But I try not to do that too often, because whenever I do that, there's a serious risk that I'm actually just going to make exactly the wrong decision at the wrong time. And in fact, that isn't a bad example of that, because by having more exposure to the US, it actually did very, very well in 2020. But now, of course, it really isn't. So it's a good example of why I feel like for myself, it's good for me not to make too many of those tweaks and just to stick with the broad plan, diversification and rebalancing.
Yeah, no, and obviously, like you said, during this sort of period, it's quite difficult to remain calm. So I'm going to ask you that question about the staying calm element of it, the staying patient, and dealing with the psychology of all the buffeting that the market does to us, you, me, and everyone else as investors. How do you deal with it?
Well, I think not looking at my portfolio too often, I think is yes. One way that I deal with it. I do sort of look at stock prices quite a lot, I've got to admit, but I don't. I try not to emotionally engage with that, because I always remember Benjamin Graham's great metaphor. He wrote a book called The Intelligent Investor, and his sort of metaphor is Mr. Market, which I'm sure you and a lot of your listeners will be familiar with, but if you're not, Mr. Market is a character who's, you know, very, very optimistic one day and super pessimistic the next day. So on a good day, he'll offer you, you know, really high price for the companies in your portfolio, and on a bad day for exactly the same companies, he'll want to sell them, and he'll offer to sell them to you for a really low price. And so Mr. Market gives you the opportunity to sort of buy low and sell high. All the time, just because really of his mood swings, but the businesses, the underlying businesses that you're sort of buying and selling, haven't really changed that much. So it's not a bad metaphor for understanding how the market works. Obviously, it's a bit of a simplification, but you're talking about ways to remain calm and actually keeping that idea that, you know, the what's moving the stock market up and down is actually just, you know, Mr. Market a lot of the time. And if you have, you know, a 5-year or a 10-year view, you know, you're the owner of the companies in your portfolio. You're one of the owners. And, you know, if you're running a business, you don't sort of sell it, you know, 1 minute because, you know, investors are panicked or whatever. You own it for the long term. And I think that's definitely the way I approach my investing. I'm definitely not a trader, and I don't particularly trust my emotions and my sort of gut feeling on things. I like to have a plan that I've kind of worked out as logically as I can and stick to it.
Brilliant. Love that. Now, you've touched on it a little bit, so I'll ask the question. We're currently in a high inflation environment, Nick, where the world and everyone else seems to be talking about and using the word recession. It's often being mentioned in lots of different areas of the investment industry at the moment. Do you feel that we're in a situation where you, me, and everyone else can prove more resilient in these uncertain times, and why?
Yeah, I think, well, I think a recession is going to mean different things for different people, isn't it? And you know, if we're talking about kind of the real economy, obviously it has lots of pretty terrible impacts on people's lives. And I think, you know, you have to start by thinking about that. I think in terms of the investment world, what we're looking at the prospect of potentially is an earnings recession, where companies' profits are going to start to shrink. And that is something that could clearly extend the stock market declines that, you know, we've already seen, which up till now have been, as you know, pretty much based on revaluation of companies because of this higher expectations for inflation and interest rates. So I think, you know, it's going to be a testing time. We're not necessarily at the bottom of it yet, and it's going to be important to be resilient, as you said, patient. I like the words you've used. You know, focused on the long term and as calm as we can be, and hopefully we've put in place strategies that allow us to do that. You know, so we haven't invested money that we can't afford to lose, or that we need, you know, tomorrow or something like that. And if that's the case, then, you know, there isn't really any reason to panic. We need to sort of stick to the plan. But what we will learn a lot through this period as well, because every one of these sort of crises and crashes and downturns, we learn something else. We learn something from financial crisis. We learn something from, I'm sure you remember March 2020, we had no idea how that was going to play out. In fact, the markets just snapped back very quickly, but we had no idea that was going to happen. And this one will be different again. And each time we learn a little bit more that we can incorporate into our investment decisions, into our you know, view of markets and how they work.
Brilliant. Thank you very much. Now, Nick, you're married, got some, I think, 3 children.
That's right.
And
yes.
Therefore, yeah, you've got junior ISAs now for them.
Yes.
Have you started early, and what are the benefits? Can you share the benefits of why it's important to start investing early for our listeners, please?
Sure. Well, it's important to start early if you can, because of the benefits of compounding. And because I'm not Annabelle, I haven't come on this call with the right facts and figures. But if she'd come on the call, she'd have told you that, you know, an investment, £100 investment 18 years ago would be worth, I don't know, whatever, large four figure sum now. But that's all very true. You know, compounding over the time, if you can afford to put some money into a junior ISA for your kids, then that's great. I mean, the junior ISAs aren't actually my main vehicle for saving for my kids, because the junior ISAs obviously are in their name, and it becomes their money when they are 18. And whereas I'm very happy, if their aunt gives them, £20, I'm very happy to put it into that junior ISA for when they turn 18. If we're talking about the slightly more serious sums that might enable them to, maybe help to buy, to put down a deposit on a home, I don't think the junior ISA is the right place for that, because the junior ISA for them is their money to do whatever they want with when they turn 18. But if you want to have any discretion over it as a parent, clearly junior ISA is not the right place for it. So most of my wife's savings for them are really in ISAs under our own name. I don't know if that makes me a bad parent, but
it's really good. It's really good that you've
practical.
cleared that nuance up as well, because it is important to recognise that, regardless of how we bring up our children, at 18 they're going to go, woohoo, I'm off there, they've got all this money, and then you're going to go, no, but the plan was for this, and they go, no, it's my money, I'm doing what I want. So that's really
exactly my point. You put it much more straightforwardly than I did, but that's basically exactly what I'm saying.
Absolutely spot on. Now, I'm conscious of the time, so I'm going to ask you one more question. And we've talked about learning and education here. I'm going to ask this question here, Nick. Howard Marks, the American billionaire investor and co-founder and co-chairman of Oak Tree Capital Management, wrote the brilliant book, Lessons from Market Cycles. The market's a classroom where lessons are taught every day. The key to investment success lie in observing and learning. As an educator, an individual passionate about all things investing, Nick, what has been your greatest learning to date?
Yeah, that's a tricky one, because I might end up reiterating something I've already said. But I think
absolutely fine.
But I think if I could probably give you a concrete example. It's just not trusting your emotions. I think a good example of that would be, people who are nervous of flying, because if you sit in a plane and it's taking off, then everything in your body is screaming that this shouldn't be happening, and this big heavy thing shouldn't really be able to get into the air, and it's all terrible. You feel terrible feeling in the pit of your stomach. Basically, what your body is telling you is wrong. It's actually extremely safer than driving a car down the motorway. And I think investing is a little bit like that. It's just you are not physiologically set up really to deal with investing. So you have to recognize those emotions that are not really helping you. If you think that you don't have them, if you think, no, I'm logical and everything I'm doing is rational, then you're probably more vulnerable to making those mistakes than somebody who just recognizes their emotions. I mean, just one example is, as I had an investment in a biotech fund, and just from sheer luck, I happened to invest in this at a very good time, and it went up in a very short space of time, about 100%. And I then sold it. It was fantastic, and I sold it because I thought, I'm feeling really, really uncomfortable. This thing has gone up 100%. I broke my own rule. I listened to my gut, my emotions. My gut was saying, no, take your profits. It's gone up 100%. So I sold it. And of course, then it kept on going up quite a long way. And I just thought to myself, Nick, this is exactly what you always tell yourself. You listen to those emotions and go by your gut. And you almost invariably, it's actually quite comical. And any other time I've done that, maybe I felt a bit nervous about the markets or geopolitical events, and I thought, no, I'll just hold this money back and drip feed it. And again, would have done much better to put it all in straight away, because regular investing, and I'm not knocking regular investing, because regular investing is great for keeping calm and keeping to the plan and all those wonderful things we talked about. And also, just practically, it's the only option for many people, including myself, because we only get money every month rather than a big load of it at once. So regular investing is great. But if you do, I think, look at the evidence, then most of the time, and we do at the AIC every now and again, do these comparisons. Most of the time, really, it's a have a lump sum. It's actually better to get it all in. Of course, you could be very unlucky and invest it at the top of the market. But the way markets work is that they usually go up. So delaying that investment has an opportunity cost. So yeah, basically keeping your emotions under control, understanding them, keeping them in check, trying to keep to the plan is, I think, the most important lesson I've learned about investing and that I'd like to share with others.
Fantastic reply. Thank you ever so much. Nick, that was brilliant. Thank you.
Thanks,
That
Peter.
was Nick Britton, Head of Intermediary Communications at the Association of Investment Companies. Nick, been an absolute delight having you on the show.
Thank you, Peter. It's been wonderful.
I couldn't get to the AIC party that was last week, unfortunately, because of the strikes. But I'll hopefully see you, Annabelle, and the rest of the team next year, if I'm invited again, that is.
Please, we will always invite you to that. And please, I really hope you can come. It'd be great to see you there.
All right. Thank you very much. Take care and love to the family, Nick.
Thanks, Peter. All the best now.